Assalamu alaikum. Welcome to day 14 of Performance Management 15 Days Revision Crash Course. And the topic today is Divisional and Performance Measurement and Transfer Pricing. So we're just one day away from ending this revision crash course, but you need to promise me that you are going to do your job well, and that is to touch all the important questions from your revision kit, do questions on your CV platform, and make sure that you're thorough with all the syllabus area. If you are not, then this is the time to revisit and finish your weak areas. Okay, so now we are going to start with transfer pricing and divisional performance measurement. For transfer pricing, what is the objective of transfer pricing? Goal congruence. Okay, so divisional decisions are the correct decisions for the group. To make sure, it's important that you set the transfer price at the right price. Okay, if the transfer price is too high or too low, one division is going to suffer over the other. Next, performance measurement. Through transfer pricing, you can achieve your objective if you set the right transfer price. Then autonomy, it gives you the freedom. Minimizing global tax liability. You have the freedom of flexibility, I must say, in setting the transfer price in such a way that overall you can minimize your global tax liability. Now, transfer pricing comes when one department is selling to another department or buying from another department. They are in the same company, same group, but it's between department, inter-department transfers. That is known as transfer pricing. And to record the movement of goods and services. From your exams point of view, you might be given a transfer price and you might be asked to comment on it. Okay, so look at the following. You might be asked what is the implication for divisional performance. Example is a target return on investment achieved. Then resulting manager behavior. Does this give dysfunctional decision making? Will a manager reject a new product that is acceptable to the company as a whole? Sometimes it happens. A manager rejects a product that is good for the company, but he rejects because he is not getting the benefit, self-interest. So this decision making is dysfunctional, right? Not good for the group overall. Might be good for the manager, individual manager, but overall is not good. Now, general rules that one must remember in transfer pricing. First one, optimum transfer price is equal to marginal cost plus opportunity cost. Okay, and the minimum transfer price that selling division will accept is the same optimum transfer price only. This general rule gives the following transfer prices in three specific scenarios that you can see in the exam. First could be in a perfectly competitive market. That means your transfer price is equal to your market price. Second, if spare capacity exists, transfer price will be equal to marginal cost. And if production constraint, limited scarce resources are there, transfer price is equal to marginal cost plus opportunity cost of not using those resources elsewhere. So you must remember these three. And in your exam, you must see out of these three, what is your scenario and apply the transfer pricing accordingly. Practical transfer pricing system. Okay, those were the general rules. What is the practical transfer pricing system? These are some types of transfer pricing through which you can set the transfer pricing. The first is known as market price. Okay, this is seen as fair by manager because whatever you see, market price means you are referring your transfer price to the open market price. What is the price that I have to pay if I have to buy this product from outside the market, not from my own department, not from the other department in the same organization? So it looks more fair. Next, does an external market exist for the component? You have to see what component that you are buying from another division in your company. Will you get that same product from the outside market? If yes, okay. If no, you cannot refer to the market price. Then you have to use some other method, which we are going to cover later on. Third, prices may be linked to volume. So which to use? Because in the open market, the price that you charge are based on some volume, right? But the volume that you are taking from your division is different. Then maybe more than one market price. Possible. Then which one to use? Are cost of selling externally the same as for internal transfer? Next is production cost plus markup. You add up all the cost and you add a certain markup. So here you have to decide when you're costing, are you using full cost or marginal cost? Full cost means fixed plus variable, marginal means only variable. We have covered costing before, by the way. So full cost can cause problems. If the transfer pricing is viewed as a variable cost by the receiving division, then you will face a problem. Then if you charge a full cost, you will not be able to sell it to the receiving division, because they are assuming the transfer price is wholly made up of variable cost, but you're including fixed cost also there. Standard cost aids responsibility accounting. Then negotiation. This looks at the bargaining power of different parties and they set the price. Whoever is more powerful are more likely to set a price. Then maximum transfer price that the buying division will accept. We told the minimum transfer price that the selling division will accept is what? Optimum transfer price, right? Earlier I've told you what is that optimum transfer price. Go back and see. But for the buying division, the maximum transfer price that they are willing to pay is the lower of those two. Lower of what they have to pay to the external supplier and the net marginal revenue of selling the final product. Whichever is lower is the maximum transfer price. Now, here the net marginal revenue is equals to final sales price minus additional variable cost. Next, divisional performance measurement. How do you measure the performance of a division? There are some considerations here. Manager or division. Type of division. So here we have divided this into type of division, then we have described them and typical measure for them, each of them. First one is cost center. There are three types of division: cost center, profit center, and investment center. Measures for each of them might be different. So for cost center, as the word says cost, no revenue are earned in this division, only they incur cost. Okay, so measures will be in terms of cost only, total cost and cost per unit, cost variances. We have covered variances before, and also total cost. NFPIS, that is non-financial performance indicator. They relate to quality, productivity, and efficiency. Okay. Next is profit center. Here they have cost as well as they earn revenue. But manager does not have the authority to change the level of the investment in the decision. Measures will be all of the above. All of the above means what? Whatever was there for the cost, they take all of them. That is total cost, cost for profit, cost variance. Plus, in addition to this, they have this also. Remember, profit center is not only profit, they can have cost loss also. I mean, they have cost also there. That's why we are taking all of the cost centers measures with this one. Total sale and market share, profit, sales variance, working capital ratios. Next, and in the non-financial performance indicator relating to customer satisfaction also. Third center is investment center. Here, same, it has cost and revenue, but here the difference is manager has the authority to change the investment. That means they can invest in new fixed assets or they can dispose of the existing ones. Measures will be all of the above. That means the cost center, profit center, plus this return on investment, ROI, and residual income, RI. We are going to cover this two measure in detail. So return on investment. Okay. You have to understand the drawbacks of this. Very important for the exam. And the formula is this: pre-tax controllable profit divided by controllable equity capital employed. Residual income. See, ROI and ROCE, we have covered ROCE in the previous day when we have gone through the ratios. The first ratio under profitability was ROCE, return on capital employed. The formula was operating profit divided by capital employed. This one and ROI is little bit different. Do not confuse the two. Okay, ROI as pre-tax controllable profit and controllable capital employed. Whereas the residual income, is pre-tax controllable profit minus imputed charge for controllable invested capital. Advantages of ROI. It gives you a relative measure because it is in terms of percentage. So that's why it's easy to compare between divisions of different sizes. Next, use externally and therefore understood by users. It encourages a good use of existing capital resource. It can be broken down into secondary ratios and more detailed analysis. Disadvantages. It might lead to dysfunctional decision making. How? Let's say a division is having a current return on investment of 30%. So if there is any project that gives a return of investment below 30%, they are not going to accept it. Let's say 25%. But it might be good for the long term. Still, they will not accept any project below 30%. Then this ROI increases as asset gets older. Remember this. So if NBV is net book value. So if net book values are used, that means managers have this incentive to use older inefficient machines, because older the machine, ROI will increase. So they want to increase the ROI, right? So for that they will use inefficient obsolete machines also, even if it's not good. They will hang on to this type of machine. Then, because I told you, like, ratios could be manipulated because they are accounting measure. Same for this also. They can manipulate profit or capital employed. And if different entities are using different accounting policies to calculate ROI, it can confuse comparison. Advantages of RI. The problem with ROI is you reject a you reject a project if it's below the division's current ROI. But RI reduces that problem of rejection. So that means you will accept a project even if ROI is low, because it's good for the group. Even though individually, for the individual division, it's not good. Okay. Next advantages is cost of financing a division is brought home to divisional manager. Disadvantages are, if the divisions are of different sizes, you cannot compare. But in ROI, you are able to compare. Profit and capital employed may be subject to manipulation. Same disadvantage as ROI. Now the questions are MOP, Division A, ROTEC. Thank you for watching, and it's just one day away. That is day 15. So make sure that you watch all the previous revision videos, and you can download all those PPT slides from my channel. Go to About section, scroll down, click PM Revision Crash Course. Thank you, and I shall see you in the last revision crash course.